On Friday, the stock market had its worst day since October. The S&P 500 dropped 2.6%, the Nasdaq fell more than 4%, the Dow lost about 1.33%, and roughly $1 trillion just evaporated from the market in a single session. If you opened your brokerage app on Friday afternoon, you saw a sea of red, and your stomach probably did a little flip. Here is the part nobody is screaming about in the headlines. Just 3 days earlier, on Tuesday, the S&P 500 closed at 7,609, the highest closing price in the entire history of the stock market. So the market fell from a record high because the economy got too strong. And honestly, that is one of the best problems an investor can have. So today I want to walk you through what actually happened, why this is good news wearing a scary costume, and why I am treating this dip as a gift instead of a threat. Welcome to Sarah Finance, where we break down the money news every single day so you can stay calm while everyone else panics. If that sounds useful, hit subscribe because this stuff moves fast and I would love to keep you updated. Now let us get into it. Let me set the stage because context changes everything here. Coming into this week, the market was on an absolute tear. The S&P 500 had climbed about 20% over 9 weeks. It had just put together a 9-day winning streak, its longest since May of last year. And remember where this run started. Back in April, the market had fallen as much as 19%, almost a full bear market when the tariff news first rolled out. Then the harshest trade threats got paused, optimism came rushing back, and stocks went on a historic climb all the way to that record high on Tuesday. So when you hear the market just dropped, your brain needs the second half of that sentence. It dropped from the top of the mountain, not from the bottom of a hole. Those are two completely different stories, and the difference is the whole point of this video. Let me also walk you through the week itself because it tells you something. On Tuesday, we got that all-time record close above 7,600. Then on Wednesday, the 9-day streak finally snapped, with the S&P 500 slipping about 0.75% as oil prices and bond yields ticked up. That was the first little crack. And then Friday delivered the big one, the worst day since October. The Nasdaq had the roughest week of all, down close to 5%, while the S&P 500 lost more than 2% for the week. So this was not one random afternoon out of nowhere. It was a market that had sprinted 20% in 9 weeks, simply running out of breath at the very top. So what actually knocked it down on Friday? This is my favourite part because the reason is almost funny. The economy came in too strong. On Friday morning, the May jobs report landed and it showed the economy added 172,000 jobs. That was roughly double what economists were expecting. Unemployment held steady at 4.3%. In any normal universe, that is fantastic news. More people working, more paychecks going out, more spending, a healthy and humming economy that is creating jobs at twice the pace anyone forecast. But Wall Street has this weird little personality where sometimes good news is bad news. Here is the logic. When the job market is this hot, traders worry the Federal Reserve will keep interest rates higher for longer instead of cutting them soon. And right after that jobs report, the 10-year Treasury yield jumped to 4.54%. Higher yields make borrowing more expensive across the economy, and they make safe government bonds look a little more tempting compared to riskier stocks. So traders who had been betting on rate cuts coming soon suddenly gave up on that idea, and they sold. That is the whole story. The market did not fall because something broke. It fell because the economy is doing so well that the easy money crowd got nervous about not getting their rate cut. Think about that for a second. The thing that spooked Wall Street on Friday was 172,000 of your neighbours getting jobs. When you say it out loud, the panic kind of falls apart, doesn't it? $1 trillion moved because the labour market was healthier than expected. That is the kind of problem a struggling economy would love to have. Notice what a sell-off like this really is. A day like Friday is mostly a bet on what one committee of people is going to do with interest rates over the next few months, rather than any real judgment on the companies you actually own. Traders were leaning hard on the idea of near-term rate cuts, and that strong jobs number forced them to walk that bet back in a hurry. But notice what is being argued over here. The disagreement is not whether the economy is healthy. Everyone agrees it is healthy. The only disagreement is over the exact timing of a rate cut that may simply arrive a little later than the impatient crowd hoped. When the worst thing people can say about the market is that the economy is too good for an immediate rate cut, that is a market in a fundamentally strong position. Remember, this is the same market that fell almost 19% back in April on tariff fear, then climbed roughly 20% in 9 weeks to a brand new record. It has already shown you this year that it can take a punch and come right back swinging. Now, the drop was not spread evenly. The pain was heavily concentrated in one corner of the market, and that corner is the chip stocks. Broadcom fell more than 7%. Marvell dropped around 16%. Micron fell about 13%. Intel and AMD each fell around 11%. That is a brutal day for semiconductors, and there is a reason it hit them hardest. These AI and chip names were the engine of the entire rally. According to UBS, technology drove about 57% of the gains in this run, even though tech is only about 35% of the index. So when traders wanted to take some money off the table, they sold the stuff that had run up the most. The biggest winners simply became the biggest sellers on the way down. That is not a sign the AI story is suddenly over. That is just gravity doing its thing after a rocket launch. When something climbs that far that fast, it tends to give a little back, and the parts that climbed the most give back the most. And there is actually a quiet bit of good news buried in that. When a drop is concentrated in the names that ran up the hardest, it tells you this was profit-taking, not panic about the whole economy. If investors truly believed something was breaking, they would be dumping everything, not just the chip stocks that had doubled everyone's expectations. Instead, they trimmed the rockets and left the broader market in far better shape. For a long-term investor, a day where the most expensive, most loved corner of the market suddenly gets cheaper is not a tragedy. It is the market handing you a better entry point on the exact theme everyone was chasing at full price just a week ago. Here is where I want to zoom out, because this is the detail that everyone missed in the noise. Even after that ugly Friday, even after $1 trillion came off the board, the S&P 500 was still up double digits for the year, more than 10% year to date, and it was still sitting comfortably above its April low. So a person who simply did nothing, who never checked their app and never touched a single button, is still up nicely on the year. The scary red day did not erase your gains, it just gave a little bit back, and that distinction is everything. There is a massive difference between losing money and giving back a slice of a very large win, and most of the headlines are quietly hoping you will confuse the two. If you are finding this helpful, take 1 second and hit that subscribe button. We do this every single day at Sarah Finance, breaking down exactly what is moving your money so you never feel lost when the headlines get loud. Alright, here is where it gets genuinely useful, because I want to show you why this kind of day is not something to fear. It is something patient investors quietly wait for. Let me give you some history, because history is the great calmer of nerves. Pullbacks like this are not rare events. They are the market's normal heartbeat. Since 1927, the S&P 500 has spent about 29% of its entire history trading at least 10% below a recent high. Read that again. Almost a third of the time, the market is sitting somewhere below its peak. Being off the high is not the exception. It is the everyday weather. If you only ever invested when everything felt perfect and the market was sitting at a fresh all-time high, you would have sat out nearly a third of stock market history, and you would have missed an enormous amount of the growth that happened on the way back up. And these dips arrive on a fairly regular schedule. On average, the market gives you a roughly 5% dip about once a year. A 10% correction shows up about every year and a half. A 15% drop comes around every 2.5 years, and a full 20% bear market arrives about every 4 years. None of this is a malfunction. This is just what the engine sounds like while it runs. Once you internalize that rhythm, a 2.6% down day stops feeling like an emergency and starts feeling like an ordinary Tuesday. The investors who sleep well at night are the ones who already expected days like Friday before they ever happened. So why do I get a little excited on days like Friday? Because when prices fall, stocks are essentially going on sale. Think about how strange we are as humans. When our favorite store runs a sale, we get thrilled and we buy more. But when the stock market runs a sale, we panic and we run for the exits. If you are a long-term investor who is going to keep buying for years, a lower price is literally a discount on the same shares you wanted anyway. The companies behind those shares did not get worse on Friday. The same businesses are still there, still making money, still creating those jobs we just talked about. The only thing that changed is the price tag, and the price tag got friendlier. There is a famous line from one of the greatest investors who ever lived, Peter Lynch, and it is worth keeping taped to your monitor. He said far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in the corrections themselves. Sit with that one. The fear of the dip has cost people more than the dip ever did. The folks who try to be clever, who jump out to dodge the drop and plan to jump back in at the bottom, they almost always miss. They sell near the lows, then they wait for a feeling of safety that never quite arrives, and they end up buying back in higher than where they sold. The drop did not hurt them. The fear did. This is why the saying that actually builds wealth is so simple. Time in the market beats timing the market. It is not about catching the perfect bottom or dodging the perfect top. Nobody rings a bell at the exact low to tell you it is safe to come back in. It is about staying invested steadily through the green days and the red days, and letting time do the heavy lifting for you. People who quietly win are not the ones with a crystal ball. They are the ones who simply refuse to get scared out of the game when a single Friday looked ugly. And if you need one more reason to breathe easy, here it is. The market has recovered from every single downturn in its history. Every crash, every correction, every scary headline you can possibly think of, the market eventually clawed its way back and went on to make new highs. Even better, the round trip is usually faster than people fear. On average, going from a high down through the low point and all the way back to that high takes about a year and 10 months. Call it 22 months. So even in a rougher scenario, the typical recovery is measured in a couple of years, not a couple of decades. That is a finish line you can actually see from where you are standing right now. Now let me bring it back to this moment, because this is not a crisis. This is a pullback off a record high caused by a strong economy and a jump in bond yields. Let me put the calendar in front of you so you know what is actually ahead. The Fed meets on June 16th and 17th, and the market is pricing in about a 99% chance they leave interest rates exactly where they are. So there is no shock waiting at that meeting. And before that, the May inflation report comes out on June 10th. The last reading for April showed prices up 3.8% from a year earlier, mostly driven by energy costs. Those are the numbers worth watching, not Friday's scary headline. A single red day tells you about one afternoon of trader emotion. The jobs report, the inflation trend, the Fed's path, those tell you about the actual economy underneath. And the actual economy just flexed. So here is my honest, calm game plan, and it is almost boringly simple. I am not selling into this. Selling because of one bad day is exactly how you turn a temporary dip into a permanent loss. If anything, this is the kind of day I keep a little cash ready for, so I can buy quality companies at a friendlier price while everyone else is busy panicking. I keep investing on a regular schedule no matter what the market is doing that particular week, because that consistency is what removes the guesswork and the emotion from the whole thing. And I keep my eyes on the things that actually matter, like jobs and inflation and the long arc of the economy, instead of the colour of my screen on a Friday afternoon. None of that requires you to be a genius or to predict the future. It just requires you to stay calm while everyone around you loses their head. The market spent this week reminding us that even a record-setting run takes a breather, that strong jobs numbers can rattle traders in the short term, and that the headlines will always sound 10 times scarier than the actual math. Your job is simply to keep showing up while the noise burns itself out. Let me leave you with the big picture, because I think it reframes the entire week. 3 days before the worst day since October, the market hit the highest close in its entire history. The thing that triggered the drop was 172,000 new jobs. And after all the smoke cleared, the market is still up double digits for the year. That is not the story of a market falling apart. That is the story of a strong economy taking a normal breather and handing patient investors a discount on the way through. The headlines will always make the dip sound like the end of the world because fear gets clicks. But the calm investor who understands the rhythm sees something completely different. They see a sale. If this gave you a little calm in a noisy week, that is exactly why this channel exists. Subscribe to Sarah Finance, because we show up every single day to turn the scary money headlines into something you can actually use. Take a breath. Stick to your plan, and remember that the boring, patient investor is almost always the one who wins in the end. I will see you tomorrow.